Welcome back to the channel. In this video, we're going to be talking about what Tom Lee's take is for the month of September and for the rest of the year. Tom Lee's an expert when it comes to the stock market. He has a global research firm and has been right the last 19 months about the market. So when he talks, it has some credibility behind it. Let's take a look at what Tom Lee had to say on CNBC about the Federal Reserve and the economy going forward.
Fundstrat Global Advisors co-founder and CNBC contributor Tom Lee. Tom, the small caps that I know you're watching closely had a good day. But, I mean, is it September or is it not September, right? We had a rough start, and now some of that's in the rearview mirror.
Yeah, I mean, I think if viewers are sort of confused, I think that's what the next 8 weeks are going to be like into Election Day. I think it's a very challenging period because no one can have conviction until they really know who's in the White House. But there are some positive sort of supports coming into play, and next week is the Fed meeting. We know the Fed is going to make some cuts, and with the inflation data being supportive and the labor markets needing some support, I think it's going to give the markets some confidence. So I think we do kind of trade well into that meeting and maybe even the week or two after.
Does the market need a 50 basis point cut to stay within that 5,300 to 5,700 range that you think we're going to bounce around in?
You know, I think that a 25 or 50 has both hawkish or dovish implications.
Right.
So I think it's ultimately whether Fed Chair Powell comes across as this is the start of a cycle where they're confident that we're moving back towards neutral. And whatever number they make is actually quite dovish and positive. But if it seems like this is dragging along the FOMC members, and then there's even concerns about a hard landing, then I think the market can view anything they do as negative. I think it's going to come out positive, though. But
I mean, it seems like the Fed chatter would be in that direction. They didn't want people to get too excited about too much in terms of rate cuts. But now that they're there, it seems like they're signaling that they're kind of on a path.
Yes, that's right. But, from a market's perspective, I think that they'd like to see the Fed sort of acknowledge that inflation is moving back as a secondary concern, and supporting labor markets while not in a recession is incredibly important. So I think that you're right. There's a chance that this could all be interpreted negatively if the Fed seems really reluctant to cut.
Most people ought to be investors, not traders. So are we up against, whether we're talking about the Fed or even about the election, a potential narrative shift in the markets or no?
I think in the near term, we're losing visibility. And, when you don't have visibility, people get scared and they sit on their hands. But over the next 12 months, I think investors should be pretty confident. When the Fed has cut rates while in a soft landing or no landing, the win ratio or markets higher 6 months, 9 months, 12 months later is almost 100%. And we also know post-election markets almost always rally. So the November, December looks pretty good. And I think the policies of both candidates is good enough for markets to do well next year. So I think we might have turbulence now, but it looks pretty good after that.
Now, back to that turbulence, for people who are trading, it's been a weird September because usually when the month starts bad, it's bad. But we have this situation. How do you read it?
Well, yeah, you're right. If you took the 10 worst first week of September, it's like the 10 times a September was down 2.5% or more. 10 out of 10 times the market never finished positive.
For the month?
For the month. In fact, if you took the 20 worst first weeks of September, 20 out of 20, September was a down month. So, however, 3 out of 10 times from the fifth day, which would have been Monday, to the end of the month, you actually clawed back gains. You just didn't finish the month positive. So I think it's a strange seasonal. I might just say, to me, next week is more important because it's the Fed and the put coming into play, and that might be the dominant factor for the rest of the month, and that could be quite a support for markets.
So let's talk about some broader issues, particularly mega caps versus small caps. We saw a big comeback for NVIDIA. We saw really some continued flexing strength from the likes of Apple, which is now, I would say, firmly on top in the market cap race, such as it is. And then we've seen small caps struggle more than some might have hoped. So today is an exception. Which is more influential in this market?
They're both important, and they reflect different investor views. I think you still always want to own the best companies in the most important themes. I mean, that's NVIDIA and that's Apple. And they're going to really work over any cycle. But when the market begins to believe the Fed is going to move rates back towards neutral, and that's both cost of money, mortgages, auto loan rates, these are really big tailwinds for cyclical stocks and small caps in particular. So I think that's why I'd still want to make a very educated bet with high probability that small caps could do very well the next 12 months and even between now and year end.
Let me know down in the comments if you agree with Tom Lee's take or if you disagree. Be sure to like and subscribe, and I'll see you guys in the next one.